Hey future millionaires, welcome to another ETF review. Today we're going to review 4 VanEck ETFs. We're going to do a deep dive on each ETF, look at the performance, and then take a look at what the balance would be if you invested in all 4 funds consistently over a 5 and 10 year span. Please take a moment to like, subscribe, and share with some friends and family. And on top of that, get ready to sit back, relax, and enjoy another ETF review. Let's jump into this ETF review. Again, we're going to look at 4 VanEck funds. But before we jump into that, we're going to cover what an exchange-traded fund is and how to buy them. In today's ETF review, we're going to focus on 4 VanEck funds. Again, the Morningstar Wide MOAT ETF, the BDC Income ETF, Environmental Services ETF, and the Fallen Angel High Yield Bond ETF from the VanEck Group. Again, what is an ETF? First off, it is a basket or a group of investment securities that trade on the stock market. And since they trade on the stock market, the key word is trade, ETF share prices change all day. They tend to also have lower expenses and fewer brokerage commissions, which make them a great option for all of us who are starting out and who want to do some long-term passive investing. But how do you buy an ETF? Well, quick 4-step process. Determine the type of account, whether it be an IRA or a brokerage account, because usually ETFs are not available in a 401k. Then from there, you open up the account with an investment firm. Then from there, you determine how frequently you're going to make your investments. So usually we tell people, if you can, if your budget supports it, go with the same pace in which you get paid, weekly or bi-weekly, in some cases monthly. Now, if your budget can't support it because you have too much variable expenses, just target monthly, as long as you get there. And a good tip, set it up to be automatic transfers in and automatic purchases of those ETFs that you've selected. Now, for each ETF, we're going to take a quick look at what ETF category it is, the fund benchmark, fund summary, expense recap, top holdings, which will tell you, it'll help play into what the fund performance is. Now, jumping into it, first off, we've got the Morningstar Wide MOAT ETF. This one is the ETF category of large value. This one is working to seek to perform against the Morningstar Wide MOAT Focused Index. All right. Now it gives you the index name, MWMFTR. And what's our expense recap? 0.47. So that means for every $10,000 you have invested, you have $47 in expenses annually. Jump into those holdings. For this one, you have 55 different investment securities. And now what do you have in there? Companies like Alphabet, International Flavors, RTX Corp, Tyler Technology, Charles Schwab Corp, Altera Group, Allegon, and Campbell Soup. All of those top 10 make up about 28% of all the holdings and 28% of all the net assets. Now let's jump into it. 55 holdings. How many industries do you have? How many sectors? You've got healthcare, 20%, industrials, 18%, information technology at 15%, financials at 14.4%, and consumer staples at 11.2%. The rest are under 10%, but you get a good sense of where this is going. Great diversification against 55 companies. Look at that performance. All right, check it out. So, our 1 year is 16.76, 3 year 6.89, 5 year 15.43, and 10 year of 12.66. And if you've been in it since the beginning, and for this fund it tells us in 2012, if you were one of those diehards who bought this in 2012, you had 14.19 as your total returns since inception. Now let's jump into the next one. All right, this one's the VanEck BDC Income ETF. This one, call out, has quarterly dividends. All right, so it's the business development, so that's your BDC, Business Development Company Index. Expense ratios is really interesting, is very different. It's 11.17. Now, how is that broken up? So this one's tricky. It has a 0.4 management fee. So for every $10,000 you have invested, that'd be $40. And then it has an acquisition fund fees. So it's acquiring funds within this fund, and it's taking 10.75. So you would have 10.75 in expenses. So this is a little frothy. Hopefully the returns are there, but you're also hoping that the dividends are strong enough quarterly to wash out that 10.75. That's what you're investing in this for. to get that quarterly dividend and have performance on top of it. The combo is what you're looking for here. Not all ETFs have dividends, and most of them, even if they do have dividends, they do something like annually, where they're accumulating annually. This one is intentional about doing quarterly dividends. Now let's take a look at what do you have in there. You have Ares Capital, 27 holdings, Ares Capital, Blue Owl Capital, Capital, FSKKR Capital, Hercules Capital, Main Street Capital, Blackstreet Secured Lending, Sixth Street Specialist Lending, Perspectives Capital, Morgan Stanley Direct Lending. So look at it. All these are financials that are doing lending, and that's where those financials are going to give you back a dividend, and that's what the acquisition fee is driven off of all this. But these 10 alone make up 73, almost 74%. And look at that, Ares Capital, that first one is 20%. If you're looking for diversification, I'm going to call it out. This one's not the one. But if you're looking for dividends, maybe it's here. And hopefully there's a good coupling with performance. And so again, sector weighting 89.3 is financials, and the other one's just cash. All right, now let's take a look at what those returns are. Wow. So that 1 year, 31.92. So 31%. That is helping make up for 11% expense ratio. Although some experts would argue you could probably get that somewhere else. Definitely technology in the 1 year would be a good example. But anyway, 1 year, 31.92. 3 year, 11.32. 5 year, 12.75. 10 year, 8.61. And 8 year, 8.22. And I got to say, you know what? It's hard to track dividends that are paid back to this. But if you had a dividend 3, 4, 5% on top of this since inception, you're doing great. Especially if you want that dividend income to come back to you and take it as a distribution because you're in your retirement years. But this one's been around since 2013. Again, this is one of the most interesting ones I've done in a very long time. Very interesting returns. Now let's jump into the next one. All right, next one is our environmental services. This was in an industrials category. This one's seeking to track against the NYSE, New York Stock Exchange, ARC Environmental Services Index. Expense recap, expenses of 0.55, so that means $55 for every 10K. All right, now let's jump into the holdings. What do we have in this one? We have 21 different stocks. Well, it's pretty concentrated, 21. But what companies do we have? We've got Ecolabs, Waste Management, Republic Services, Waste Connection, Cleaning Harbor, ABM Industrials, Casella Waste, and Donaldson's Co. So great list, obviously, of many of these are waste management or some type of cleaning company or services company around this. And that's how this is the breakdown. So that's 21 different companies. Let's see. This is how the sector breakdown goes. Oh, I like this. So you've got industrial 78%, but then, like I said, so chemicals and companies, you've got 11% in materials, 4% in healthcare, and 4% in staples, consumer staples. All right, now let's jump into the returns here, the performance. We got a 1 year 17.52, 3 year 6.12, 5 year of 12.12, and 10 year of 10.32. And then since inception, this one's been around for a while. It's coming up on its 20 in about 2 years. It's been around since 2006, and 9.34 is what you would have enjoyed since 2006 on this fund. Now let's move into the Fallen Angel High Yield Bond. This one is a high yield bond category ETF that goes against the U.S. Fallen Angel High Yield Bond Constrained Index. And the expense recap, expenses on this one is 0.25. So that means for every 10,000, you would have about $25 in expenses per year. Now, let's move into the holdings. All right, nice diversification. I like that step back into diversification. 131 different companies. And we have companies like Vodafone, Noel Brands, Walgreens, Resorts World, Las Vegas, Telco Italia, and EQM Midstream Partners, and Telco Italia Capital again. So you've got 3 different positions there. So there's probably different classifications of stocks there. Class A, Class B type stuff. But when you put together just the top 10, only 21%. And I like this also. Look at that. Those net assets is less than 5% on all of them. That's great. That you have some built-in protection there. But I also call out, because there's a lot of these that are connected to some level of maturity, they're calling out the coupon rate. So that's your interest rate on the actual maturity. So these are holdings of companies, right? Of bonds from them. And then from there, because this is a bond fund, you see the maturity date too. You've got ones ranging all the way up to the year of 2079. And that's why the longer the maturity, the longer the date, the higher the maturity coupon rate is, right? And then you've got ones that all the way in 2026 as an example that they're listing out. And that one's getting 4.2. So again, these are all bonds from these companies that are providing these returns. And now let's take a look. So those sectors of these companies, you've got consumer cyclicals, technology, energy, real estate, and then from there you go ones that are under 10%, real quick, the quick rattle: industrials, financials, consumer non-cyclicals, healthcare, basic materials, utilities, and other cash. And that's what makes up the ANGL high yield bond ETF from VanEck. Now let's jump into that performance. Let's see what it looks like. To the performance. Okay, so what do we have here? We have a 1 year of 10.67, 3 year of 0.82, so that's less than 1%, a 5 year of 5.07, 10 year of 5.62. And since inception, that's in 2012 for this one, April 2012 would have been 6.74. So again, very interesting fund here. I believe this is my first high yield bond ETF review. So interesting returns here. Again, since inception, 6.74. Moving on. What would our balance look like if we invest in all four of these for a 5-year span and a 10-year span? Let's check it out. Let's take it to the spreadsheets and see what the balance looks like. Now let's jump into it. So today we're going to have someone who invests consistently about $7,000 annually. And then from there, again, as a reminder, we've got 4 ETFs. The first one's the Morningstar, 1 year, 16.67, 5 year, 15.43, 10 year, 12.66. And then our next one, the BDC Income ETF, 1 year, 31.92, 5 year, 12.72, 10 year, 8.61. Followed up by the Environmental Services one, 17.52, 5 year 12.12, 12.12, and then 10 year 10.32. And then finally our high yield bond ETF. This one is 10.67 for 1 year, 5 year 5.07, and then 10 year of 5.62. Again, we're going to take a look at what the balance would be. So again, let's take a quick look. So 1 year would have been $8,000. So $8,345. But we're long-term investors, right? We're not looking for the short-term gain. So let's take a look at that 5 year. What would it be? Okay, let's check it out. First off, our overall balance would be $49,000. And what would that be composed of? It would have been about $35,000 in principal. So that's $7,000 for 5 years. So that's $35,000. And the rest would be growth, my friends. So your balance would be $14,000 of growth. So let's break it down percentage-wise. Again, that'd be 71% would be principal and 29% would be growth. Now, I think it's going to be a little more exciting when we jump to the 10-year mark. Yeah, we did it. We pulled off. We went above the 100K. I love when I do a review and we make it over 100K. So, all right, check it out. We have a balance of $119,000. You would have had principal of $70,000, and then that's 59% of your balance. And the rest would be growth, my friends. $49,000 in growth. And let's break it down again. So you can see it growing. The blue line is your contributions or your principal, and it just keeps growing and growing and growing. So again, in the 5 year game, you would have had 35,000, and then you would have had 46,000 as your total balance. So now in your 10 year, 70,000 principal, and then right there, that delta is the 49,000. That's your growth. So not bad. Interesting. Some of the most interesting ETFs I've looked at in quite some time, especially that one with 11% interest rate, expense ratio, but that was due to the acquisition fees. But again, look at that growth. Not bad. We broke 1,000, consistently investing just $7,000. Hope you see the potential of these ETFs. There are many, many, many out there. You've just got to really hone in, get yourself in the position to invest consistently. Hope you enjoyed the review. See you in the next one. Hey, thanks for staying to the end. This video is brought to you by the Next Chapter team. If you enjoyed the video, please take a moment to hit that like button, drop a comment, subscribe, share with your friends and family. This will help the channel reach out to more individuals just like you. We offer one-on-one coaching where we work with people and small businesses to determine a clear path to achieving their financial goals. This includes things like budgeting to reduce debts, planning for big purchases, and even learning how to build wealth with the tools that you have readily available to you. So please see our link below to schedule a free 30-minute call with our team to talk through coaching and understanding your current financial situation. Also, check out some of our affiliate links below for a high yield savings account. This is a great place to put your money when you're saving up for those big purchases and your emergency fund. Check out some of our videos right here, and please enjoy and see you in the next video.